Okay, welcome to the June 13th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a little bit about the USDA report that came out. There was a lot to cover in that, and then a little bit about expectations for the EPA's finalized mandates. They are scheduled to release them either today or tomorrow or by the 14th, I guess. Historically, they haven't been great about getting those out on time, and this would already be late. So I don't know, there's probably a good chance they release them tomorrow, but ultimately it wouldn't necessarily surprise me if they did not. Okay, so on to the June WASDE report, and you can see USDA did not make any changes to their soybean oil balance sheets or US soybean oil balance sheet forecasts. The June report is a little, it's in a weird spot because the May report gives us USDA's initial look at the new crop balance sheets. And then at the end of June, we have the acreage report. And so unless there's like a big problem or a big shift in demand, USDA generally doesn't make a lot of changes in the June report, partially because we're going to have to look at their balance sheets again at the end of the month when they adjust acreage. And so the June report just kind of tends to be a non-event. That said, soybean oil prices rallied about 5 cents last week, basically. Part of it is probably the growing idea, or the idea that's being more commonly adopted, which is that the EPA will raise its mandates. I don't know that I fully buy into that. I'll explain why as we go through this presentation. But we will see, and that's what the market expects anyway. The other, obviously, far more important aspect of what's going on right now is the continued concerns about crop development and the weather forecast. It continues to feature just enough rain kind of to keep the crop going, but not enough to replenish soil moisture levels. And so I looked, as I was writing the soybean oil article this week, I looked back at crop years that were rated around where the current crop is rated. And I'll show that in a little bit. And those years tend to have lower average yields by the time you get to the end of them, sort of no matter what happens between now and in the end to the ratings. And so by extension, kind of what the growing season was. And that flies in the face a little bit of something I've said a lot on this call, which is like you can make a really good soybean crop by stressing it a little bit and then pouring a bunch of rain on it at the end of the summer when it's filling pods. I think part of the issue is that those years where the crop was rated low didn't necessarily have perfect weather all the way through anyway. And it is, while what I have said before, I still believe, if the crop doesn't get off to a good start and the crop is just kind of the whole way along, it's going to be hard to make record yields if you don't have a good start to your crop year. So it looks like the market is going to continue to worry about weather conditions until they improve sufficiently to restore soil moisture, and that doesn't look like it's going to happen until at least July. So I would say that even if you do start to get sort of good rains, at this point it may be difficult to improve crop condition ratings enough to kind of really convince the market that that the yield is going to be trendline or above. All right. Beyond that, the biggest differences between our balance sheets and USDA's are, as always, sort of our expectations for biofuel feedstock demand. For 23-24, I would say our 1.6 billion, 1.6 or 16.2 billion pounds is is going to be too high. We are just beginning to ramp up the analysis for our long-term forecast, and we're going to go back through and kind of change the way that we do feedstock demand forecasting to try and tighten up our forecast with where we sort of end up. We tend to predict a little high, and so we're going to revise that so that that comes down. And when that comes down, that'll lift our ending stocks. I really don't believe that ending stocks will be 1 billion pounds. I think they probably will be somewhere between 1.5 and 2, maybe by the time everything is said and done. Outside of that, the other big question is, will domestic non-biofuel demand slow? USDA still continues to adopt the 14.5 billion pounds. There's no reason really for me to argue with that. And the main reason that we have 12.75 in there is just to make the balance sheet work. As we cut our biofuel forecast demand, that will go into domestic non-biofuel until we get to 14.25 or 5, somewhere in there. And then after that, we'll start to raise our ending stocks, because this was the year that I really thought that we would start to see a drop off in non-biofuel demand. We haven't seen that, not only in soybean oil, but really for any of the feedstocks. And it seems increasingly like the idea that non-biofuel end users can pay more for vegetable oils and fats and greases, because for the most part, it's not a huge portion of their overall cost structure, is going to keep non-biofuel demand where it has been, or maybe a little bit higher. I mean, we could start to see it next year. If you think about how exports worked, we and other analysts, including USDA, predicted that exports would fall off for the last couple of years, and they fell a little bit, but not nearly as much as we kind of all anticipated that they would at some point. And excuse me, then this year they finally did really sort of fall off and below the level that I thought that they would drop to, historically low. I'm not suggesting that we'll get the same kind of development in non-biodiesel usage. I don't think we're going to go from 14 billion to 1 billion or 2 billion or some really, really tiny number. But I did expect that that it would moderate a little bit more than it has. And I think I predicted that for the last 2 or 3 years. And so at this point, ultimately, where I'm going to be is non-biofuel demand really is going to have to fall off before I start predicting it's going to fall off anymore. For canola oil supply and demand, again, no changes to USDA's balance sheets. The biggest difference here really is we are much higher on imports in 22-23 and then lower in 23-24. Part of that is because of the decline in our assumption for biofuel feedstock demand going forward. As I wrote the canola article this week, I was looking at the canola oil used in biofuel production, which has been really, really high since the approval of the renewable diesel pathway. And if you kind of assume that biodiesel feedstock demand hasn't really changed, that's about 130 million pounds a month. And in last month, or for March, the EIA reported that canola oil used in biofuel production was 320 million pounds or something like that. And so if we assume sort of the balance goes to renewable diesel, that could suggest that renewable diesel is going to take up 200 million plus pounds of canola oil each month. However, I think there are a couple of things that still make me a little unsure that that's actually going to be sort of the new average demand on canola oil from biofuel production. The first is that the spread between soybean oil and canola oil is historically narrow. We've talked about it a lot on this call. If you compare our RBD Los Angeles price with the RBD price for soybean oil in central Illinois. The difference there doesn't really cover the logistical difference between those 2 points. And so that suggests that soybean oil is trading at a premium to canola oil, which would make canola oil more attractive than it typically is for biofuel production. And that spread will eventually start to work its way wider and get back, if not at the long-term average, at least probably closer to the long-term average. And that will make canola oil less attractive as a feedstock because it'll be more expensive than soybean oil. It'll have essentially the same CI score as soybean oil. And so as a result, we haven't really bumped up our forecast going forward of canola oil used in renewable diesel. The other scenario, I guess, that I could sort of understand and believe in is that before the approval of the RIN pathway, anecdotally, we heard a lot of stories about renewable diesel producers buying canola oil and sort of stocking up ahead of the approval of the pathway. Again, the spread was historically narrow, and so that made sense. And in some respects, part of this almost feels like renewable diesel producers are working through those stocks. And then if the spread remains where it is, then they probably will continue. But as soon as the spread starts to widen again, they probably will slow it down a little bit. I thought that I would be more confident, in my opinion, on how much canola oil is going to be used in renewable diesel production by this point. But the March data really kind of made me wonder whether usage outside of the areas where it obviously works. So if you are in a canola growing area, I think using canola oil probably makes some sense, especially if you're in an area that doesn't have readily accessible supplies of soybean oil or some of the other feedstocks. And there are a couple of new producers that sort of sit in that category. And so I think those will probably continue to use canola oil as part of their feedstock mix. But the 320 million pounds, 250 or whatever, 200 million for renewable diesel production leads me to believe that usage probably included more facilities than just those facilities that have a geographical advantage, or where canola oil has a geographical advantage. And so that's the part that I'm kind of having doubts about in terms of what I think canola oil, in terms of canola oil usage kind of going forward. If we continue to get data that shows 320, I will accept the fact that people are going to use more canola oil than I thought, and ultimately I'll raise my my forecast. However, ideally, I think the way that this kind of would work out based on sort of Econ 101 is that as soybean oil demand, feedstock demand rises, then food manufacturers substitute canola oil for soybean oil. So to the extent that significant growth in renewable diesel demand kind of crowds that out a little bit, or if they can crowd it out based on what I said earlier about non-biodiesel usage, it does sort of limit the supply that is available for substitution one way or the other. And so I'm not 100% sure that kind of everything works if we use a lot of canola oil for renewable diesel production. And the other thing is that the increase implied by the March data, the increase in demand for canola oil, is just a little shy of U.S. production each month. And so we're already importing a lot of canola oil. We always have, but we are, this year in particular, we're starting to strain the amount that Canada can supply. And so if we're going to increase usage for renewable diesel production, and we're going to substitute canola in for food, we're going to have to rely increasingly on the crop out of Australia and probably some out of Europe and other locations that traditionally have not supplied canola oil. And if you're thinking about sort of canola oil from Australia, the additional cost to get that here and then to use it, it all seems to sort of argue against a lot of canola oil used in renewable diesel production, which is kind of why I've always sort of thought that it would be a sort of the balancing feedstock used when absolutely really needed, and in those locations where it has a logistical advantage, but not really much outside of that. So that was a really long-winded way of saying, while we're lower next year, I'm not 100% sure or super confident. I wouldn't bet a lot of money on my 23-24 canola oil biodiesel feedstock prediction. And I wouldn't, whereas with soybean oil, I would probably bet a fair amount of money that it will be lower. With canola oil, I couldn't say whether I would bet whether it would be lower or it would be higher. So that part is kind of a question mark that then impacts my forecast for imports and other in non-biofuel usage. So it's something that focused on and trying to get a handle on, but it's something that has been a little bit of a puzzle to me still. For Canada, again, no changes. The main thing that I can really say about Canadian canola oil is that if you look at U.S. imports at the trade data from April, U.S. imports kind of continued 500 and some odd million pounds, and Canadian exports to the U.S. slowed pretty sharply to 325 million pounds. We're getting into that time of the year where canola crushing starts to slow a bit as crushers sort of, they don't run out of inventories, but as inventories draw down, the typical seasonal pattern we see with crush. And so Canadian imports probably aren't going to be able to support 500 million pounds of US imports, or Canadian exports aren't going to be able to support 500 million pounds of US imports going forward. And so again, it gets back to this idea that one, that the spread between canola oil and soybean oil probably is going to start to widen. It widened a little bit last week, and that trend is probably going to continue. But two, that the amount of canola oil we use in renewable diesel, or the amount of canola oil that we used in renewable diesel during the first 3 months of the year probably isn't sustainable over the entire marketing year, and may not be a good indication of what the real demand for canola oil from biofuel production or at least renewable diesel production truly is. On the Canadian canola side, actually, the biggest question here is what is crush going to do over the balance of the marketing year. Right now, our forecast for June is 655,000 tons, but if you look at what the weekly volume implied by the prior week's crushing volumes, because COPA hadn't updated the weekly volumes yet when I tried to pull them last night, that would suggest 705,000 tons or somewhere in there. And that probably is a little bit closer to where I think we actually are right now than 655. The 655, if we end up there for June, then I will cut my my 22-23 crush forecast by a little bit, not that much. The 655 implies the last month of the marketing year crush will go up a bit more from the prior month than we've ever seen, and typically it actually is steadier, declines a little bit, and so it would suggest a cut of maybe 50,000 or 75,000 tons, maybe 100,000 tons at the most, probably, from the Canadian crush forecast for 22-23. For 23-24, I expect some growth, in part because of some expansion in crushing capacity, but also based on the obviously strong demand from the US market for Canadian canola oil. So we're above USDA on both, and we probably will remain above USDA. I would imagine. I would be a little surprised if USDA really ramped their canola crush numbers up for 23-24 until we get a little ways into the marketing year. And then we'll see where the expansion in crush is, and see if we really do get an uptick in the weekly numbers. And if we do, or if we do not, then we will change our forecast accordingly. Canadian growing conditions so far this year have been about the same as the US, but maybe a little bit better. I don't think they're quite as dry as the US, despite the forest fires that you see every night. That's not where they grow a lot of canola. Not the primary canola growing region. So I think that it is probably too early to make any significant judgments on the canola crop up there, but much like the US crop, I think if early season dryness kind of persists, then production, obviously expectations for production will come down. That will continue to support upside risk in both oilseed prices and in vegetable oil prices. The one thing that I would say is that if you think of a map of the United States and you assume that sort of the main canola growing region in North America is kind of South Dakota or North Dakota and above in Canada, the ridge that has set up that is causing the dryness and the heat in the Midwest tends to peak, a little bit above, a little ways into Canada. And what happens when you have a ridge of high pressure in the middle of the country is the storms that come in off the West Coast tend to ride up over the top of that ridge, and then rain tends to fall after they've gone over the peak of the ridge on the downslope of the ridge. And that would be if the ridge will move around during the summer, but just if you assume that it's kind of that Iowa stays dry, let's say, that would suggest that the heart of canola growing country in Canada would see at least some thunderstorms from storms riding over the ridge and coming down on the other side. Now, there would still be a part of Canada that would be dry, and the ridge will expand and contract, and so there will also be periods of heat and in dry weather in the heart of the canola growing region. Whether that pattern is going to persist through the summer, it's still too early to call. There was a meteorologist that I used to work with that was one of the best in the business, and he had a theory that basically weather patterns persist for about 90 days or so. And his theory was based a bit on, if you think about how the sun shines on the earth and where it moves to during the different seasons, he felt like if a pattern change occurred around one of the equinoxes, that probably was that pattern had a better chance of sticking around than otherwise. And we're coming up on the summer equinox here, and so if I were talking to him still, I think what he would suggest is that there's an opportunity for a pattern change once we get into actual summer, and in that the dry spring may not necessarily indicate a dry summer. The meteorologist that I use now is kind of the same opinion. We talked about the PDO a little bit last week. That's the one thing that really kind of does sort of look like it suggests that there would be a tendency for drier weather this year than we've had it in the past. So USDA saved up all of their changes for the palm oil balance sheet, the one that people probably pay the least amount of attention to. And so I showed this. I think the main points that I want to make here are probably less about the USDA data and more about our data. Joao and I were talking just before the webinar about going from 1.7 to 3.1 million tons in carryout, and that's probably a little ambitious. And so, given the El Nino, I think in the relatively near future, Joao is going to talk about what that means for our expectations for production, for palm oil production going forward. I think ultimately, you know, Malaysian production has been hampered by a lot of things in the past couple of years, really since COVID, kind of. And so I think that the sort of the impact of El Nino can be a little bit more nuanced than just El Nino bad for Malaysian palm oil production. But I will leave this for Joao to explain it to you here in the coming weeks. Outside of that, we don't really have, outside of that ending stocks number, we don't really have a significant difference with USDA. The one thing that I would say is that, again, if you think about sort of 2 million tons is the line where palm oil prices go up or palm oil prices go down. If we're at 3 million tons, we probably are going to test the 2,000 ringgit per ton level on futures next year. And like I said, I would imagine that we probably will come a little bit closer to where we are today than that number. All right, that is it for the USDA report. Okay, so let's talk just a little bit about the weather, since we kind of already have talked about this. This is the forecast for rainfall over the next couple of weeks. This is from the this morning's forecast maps. This to me looks like relatively good coverage. If I look into the detail of the rainfall forecast, the source that I use for that detail suggests only 1.5 inches of rain sort of across the Corn Belt, across a bunch of states in sort of the average across a bunch of states in the Midwest. And that looks a little light when I look at this map. I think if over the next 2 weeks we got this much rainfall across the entire Corn Belt, that wouldn't be that bad, because it's basically light blue is 2 inches. So you got a lot of areas getting basically normal rainfall, including kind of Western Iowa, which has been one of the drier areas. And so I think the weather forecast is really close to supporting good crop development. Now, the crop condition ratings would argue against that. So this week USDA said 59% of the crop was rated good or excellent. The only time a crop has been rated lower this week is in 2001, the only time since 2000. It was in 2001 when 55% of the crop was rated good or excellent. The thing is that early on in the growing season, you don't get a great comparison, because like in 2020 or 2019, when there was flooding, USDA didn't start to issue crop condition reports until nearly the end of June, or the last week in June, essentially. And so you get the poor years tend to be left out of the ratings at the beginning of the year, which is why you tend to see sort of a decline from high ratings to lower ratings during the first month or so for basically any crop, really. It's not that the crop comes out of the ground looking great and then just immediately always starts to look worse. It's just that you start to add in those poor years into the average. With the ratings where they are, it doesn't imply a disaster, but like I said, if you look back at the other years where ratings have been below 60% at this time of the year. Even in the years where the ratings climbed through the year, you still didn't have really great outcomes in terms of yields. And this is what the market is really pricing in. So if we're going to have strong demand from renewable diesel producers, and crush is going to need to be 2.27 or whatever your number is, billion bushels next year, we can take exports down, and that can help supply the bushels needed for crush. But if we grow a crop that is not at trend line, we will fairly quickly get into a spot where it will be difficult to raise expectations for ending stocks next year, which will kind of keep us where we are. Soybean prices have dropped down below the December contract, had dropped down below 12 and sort of tested 11.50. And now today it's up 35 cents or something, and is sort of testing 12.50. And that is the market just saying that it doesn't believe that the US will achieve trendline yields this year. And again, because of the history, I think until we really do get a change in the weather pattern, the market is going to, the soybean market and then the soybean oil market by extension, is going to remain volatile, and upside price risk is going to be much more significant than it would be during the normal year. During the normal year, we'd be taking weather risk premium out right now. And so I don't think, unless there is just a really convincing change in the weather pattern, I don't think that we're going to get away from this kind of setup for the rest of the summer. And so I think that that upside price risk is going to be the theme of the summer, I guess. All right, let's talk a little bit about the mandates. And actually, I didn't get the other slide in there. All right, sorry about that. Okay, there is I apologize for this. There is another chart that I had that showed sort of it showed the total mandate, and then it showed our projections for production under various categories or by various splits. And it was a waterfall chart. So the total mandate went up, and then the other side came down. And what that shows right now is that based on the current mandate and our expectations, not only for domestic US ethanol, biodiesel, renewable diesel, all of the other fuels, production and imports, it shows that the supply would be 670 million gallons short of the mandate as announced by the EPA, the preliminary mandate. So to me, raising the mandate further would widen that gap more. Now, ethanol is obviously the biggest, it accounts for 70% of all of biofuel production. And so changes in that could easily swing 670 million gallons is still a lot, but you could, if you took our current ethanol prediction and raised it by 670 million gallons, it wouldn't be that big of an increase. It's substantial, but not sort of impossible. And so I think that there's a couple of things. One, to me, it seems strange that the EPA would raise the mandates when current production isn't really on path to meet the preliminary mandates. But that's not necessarily what the EPA is targeting or probably even looking at. The mandates and the volumetric mandates that are announced each year are a little they give a guideline, I guess is the best way to put it. So the individual, the mandates that are announced are volumetric, but the individual obligations are actually on a percent basis. So percent of biofuel blended or percent of biofuel used, depending on the obligated party. And so fuel use then can reduce the volumes from the volumes that are announced by the EPA. And if you just look at ethanol production so far this year and what we expect gasoline consumption to be, which is basically where the EIA expects it to be in their short-term energy outlook, our current ethanol production estimate would imply a 10.6% blend rate. And if we added back the 670 million gallons we need to make up for the difference, it would imply an 11% blend rate. And so if you look at the average blend rate for the first 3 months of the year, it's only been 10%, including I think 9.9% in March, which is a long ways off from 11%. So it may be that the EPA leaves the mandate sort of where they are, but that kind of ends up being a little bit of an increase in production from where we are today. So and let me explain this, and this gets a little into the weeds, but the way that would work is that given that expectations for fuel consumption have fallen from when the EPA announced their preliminary mandates, if they hold the mandate volumes steady, but then they send out the final requirements to obligated parties that are a little bit higher because fuel production has gone down, but they want to hold the volumes, then that would be an increase in the mandates without increasing the volumes that the EPA announces. To me, that would sort of make the most sense and would be what would sort of align with the way that I've always thought about the EPA's final rulings on the mandates. I think it has been rare that they have ever made changes, and I think even rare that they've ever made significant changes. I can't remember a time where they've made a significant change from the preliminary to the final. A lot of times it's because they were announcing sort of the final after the year had passed, or like this year, sort of well into the year. And so I think they may have been able to do this kind of thing, or there are other small refinery exemptions and that kind of thing that can change the mandates sort of in the background without having to change the mandate, without having to announce that you've changed the mandates. And I suspect that that's probably the path of least resistance, and that's probably where the EPA heads this year as well. However, a lot of people that I talk to all expect that the EPA will raise the mandates. I think from the biofuel producers' perspective, I think that they feel like the mandate's a little bit too low, and so the EPA should raise it to sort of what has been required by law or some other target. On the non-biofuel side, I think people are just more worried about the EPA raising mandates, and that we go back from the market that we've been in for the last several months, where prices are moving lower, to the market that we've been in the last week, where prices jumped by 5 cents. And back to kind of the 2020, 2021, or 2021, 2022 big blow-off rallies. And I don't think that that the EPA will want to necessarily do something that, one, looks like it's not supporting the biofuel industry, but at the same time, they don't want to do something that looks like it's going to drive inflation higher. And almost no matter what they do, they're going to get sued by somebody. So they usually like I said, just kind of leave them unchanged. And I won't be surprised if that happens this time. And I won't be surprised if everybody else that has thought a lot more about this than I have is right, and the EPA raises the mandates. I think that whatever the mandates are, as we've talked a lot about on this call, that they are sort of one component of what feedstock demand is ultimately going to be. Because again, if you look at utilization rates and that kind of thing, then you can make an argument for sort of a wide variety of expectations for production, and all of them would be sort of, it would be sort of fair to argue most of them. Okay, so I put this chart up because I wanted to show the other chart, and then this chart was going to kind of explain where some of that gap comes from and how we fill some of that gap in. We've talked about the ethanol gap before. This year, we still are 855 million gallons below kind of what the volumetric target is. And so that number can change. But if we were using that number, we would be about 430 million gallons. It would imply about an additional 430 million gallons of biomass-based diesel production would be needed to fill that gap, or other production. So there are also, we could use biogas or some of the other categories that are growing relatively quickly could reduce the impact of the ethanol shortfall. However, like I said, it seems to me like current production implies a blend rate that is probably in line with kind of where we have been. If you assume that we export a little some ethanol and then we use the rest, 10.5% blend rate based on just production, and then gasoline consumption, kind of the simplest way you can look at it, would then revert down lower, closer to 10%, which is what, again, we've sort of actually seen from the EIA data so far this year. All right, with that, let me kind of look at, we'll look at the margin stuff, and I'll talk a bit about that, and then I will answer your questions. Hopefully those are questions this week and not like last time when I didn't share the screen. Okay, so let's go to, so the outlook for gross margins changed pretty dramatically this week for a couple of reasons. One, I think we have been sort of cutting our energy forecast, our outlook for energy prices over the last month or so, a little bit more substantially than we had been before that. And this week we cut them again. And so I think that had a big impact on it. The other part of it is really that in what is pressuring biodiesel in particular. So biodiesel is really where the change comes from. What's pressuring biodiesel in particular is the idea that biodiesel prices are going to go back to their historical relationship with renewable diesel prices, at least in the California market. And so if that happens based on kind of where we see renewable diesel prices, that would essentially pressure biodiesel margins and make them negative by August or a little bit later. And then they would continue to move down and then start to rebound maybe a little bit in 2024. There are a lot of assumptions that go behind the gross margin. So really simply, it's just feedstock costs and fuel values and credit values. But there's a lot of interaction between those three, and adjusting one can then change your assumptions about the other ones. And this week was a little bit strange because if I just ran the RIN price model on its own, it suggested that D4 RIN prices probably should be closer to 170 right now and kind of trade in that level, maybe a little bit higher going into the end of the year. But RIN prices have, while they bounced back by 10 cents over the past week, the spread between D4 and D6 has been really narrow, and the D6 prices, the model for the D6 prices just did not want to raise RIN prices, D6 prices. So what I did was I did a little bit of splitting the difference, and you'll see here in a minute, I widened the spread a little bit, but I brought the D4 RIN prices lower than the model wanted to put them. The reason that I'm bringing that up now, as opposed to when we look at RIN prices, is because if the biodiesel forecast is correct, and we get a reduction in biodiesel profitability goes negative and looks like it's going to continue to go negative and stay there forever, that is kind of what is going to be required to start to rationalize biodiesel capacity. I think that in this case, you probably would see RIN prices rising more than we're predicting right now. They probably would be closer in line with where the model predicts they're going to be than where we predicted they're going to be right now. And that would help lift biodiesel margins and keep them probably closer to zero or marginally positive or marginally negative. That's kind of where we were for, you can see a big chunk of 2019, in 2020, before things got really volatile. And I would suggest that that probably is a more likely scenario than kind of what we're showing. I wanted to show this week so I could talk about it a little bit. I wanted to be able to say, hey, look, we're in this situation where energy prices are falling and feedstock costs are rising. And if this trend kind of continues in the same way, this could be a scenario where we start to get biodiesel capacity rationalization. However, I do think that if all of that part came true, energy prices continued to fall and feedstock prices continued to rise, I think that you would have the offset on RIN prices, and you would probably also have biodiesel return to a premium relative to renewable diesel in the California market. And I say all that to say that it is going to be incredibly tough to rationalize biodiesel capacity. Certainly a small 5 million gallon biodiesel producer probably isn't going to survive for a lot longer, or I guess maybe they are. They should be printing money right now, but in the end, they're probably not going to remain in business. But the larger biodiesel producers, and certainly the integrated biodiesel producers, are just going to be really difficult it's going to be difficult to rationalize that capacity, because this is the most bearish scenario that I can set up for biodiesel margins. And even in this scenario, I can still argue that there's a way that margins don't fall as much as I'm predicting. And that's before we even start to talk about sort of state level credits or any other incentives that will make biodiesel capacity rationalization more difficult. The combination of not losing biodiesel capacity and the growth in renewable diesel capacity ultimately could and should take production for biomass-based diesel production for 2023 at least up to our expectations and maybe above our expectations. We've got some pretty big growth built into renewable diesel production, I think, into the end of the year. And that might be a little optimistic. But if we're going to sort of fill the gap between our expectations of production and the volumetric mandates, I think it's going to be this that sort of does it. Maybe we get a little bit more ethanol production, but I think that it seems more likely that a lack of rationalization of biodiesel capacity and growth in renewable diesel capacity really kind of ramps that production up, ramps D4 RIN generation up to the point where there isn't necessarily a shortfall relative to the mandates, or the shortfall is very, very minimal relative to the mandates. For renewable diesel, we kind of have margins just kind of going sideways through the end of the year. Again, if you think about this in two ways, kind of renewable diesel versus biodiesel, but also using fats and greases as a feedstock and using soybean oil as a feedstock. Biodiesel is soybean oil, have a 75% soybean oil, 25% yellow grease is our assumed feedstock mix. For renewable diesel, it's 50% leachable fancy tallow, 25% DCO, and 25% UCO. And so if you also think of it kind of in that way, soybean oil, it looks like margins probably are going to be a little bit tighter because non-biofuel demand has not gone away and has been really robust, especially very recently, while fat and grease demand also has been really robust, but we haven't quite seen the same reaction in prices as we've seen in soybean oil. Part of that's because of the weather thing, certainly, but also I think that that I could make some really bullish arguments for fat and grease prices, but I think that that those arguments are a little bit harder to translate into a widely broadcast message than it's hot and dry outside. And so I think that's part of the reason that you see the difference in the reaction of soybean oil prices recently versus the fats and grease prices. There also tends to be a lag and all of that other stuff. Okay, RIN prices. So you can see I basically left them flat, except I widened the spread a little bit for D4 from D6. Like I said, the model for D6, this is kind of, that's unadulterated there, basically. The model for D4 would have followed the trend from the recent bottom here in May, sort of up to the 170 level in this level, and then kind of leveled off. I do think that it'll be interesting to see what happens with RIN prices if we do overproduce relative to the mandates, which again, to me right now, it looks like we're short. But if we overproduce relative to the mandates and feedstock costs go up, my guess is that RIN prices will go up, but we shall see. And then finally, just LCFS credit price. I apologize, I'll get that fixed. LCFS credit prices, I took the forecast down just a touch this week. The prices kind of stalled out a little bit just above 80. And so that brought our forecast down just slightly this week going forward. We didn't change the shape at all. All right, let's get into hopefully some questions. Your current published soy oil Chicago cash price is averaging about 40 cents a pound in the first half of 2024. Are you expecting all the bear factors to persist, reduced exports, disappointing RVO, slower RD ramp up, etc.? Yeah, I think that it's partly that, and it's also the idea that South America is just going to start producing more soybeans than I think people realize right now. And that's going to weigh on soybean prices. Soybean prices, like I said, the December contract went down to 1150 and then has bounced off that. I would have expected if this spring had been perfect growing conditions, the crop was rated 75% good to excellent, I would have expected soybean prices to fall below 10, if not by December, certainly by the time that we planted next year's crop, because we'll get another probably easily 155 million ton crop out of Brazil next year, and we should get 50 million tons out of Argentina. So that's another really, if you look across South America, you can add 40 million tons of production from this year pretty easily. And so if soybean prices are below $10, then soybean oil prices are going to be lower. Soybean oil is its own independent market, and so certainly the fundamentals of the soybean oil market will have an impact on prices. But one of those fundamentals is the soybean price. And so unless crush margins are going to explode again, it kind of ties soybean oil prices down. And that's kind of where we are and where that forecast is coming from. Now, if we get an increase in the EPA mandates and the US crop is not what it's what it could have been, and so the US soybean carryout is going to stay around 200 million bushels or maybe even a little bit less, then I'm going to probably suggest that soybean prices are $13.50 in the fall, and soybean oil prices are probably 50 to 55 cents. I've started to adjust the forecast a little bit to reflect the more bullish outcome. I haven't gone all in on it yet, and I'm trying to do it in relatively small adjustments. Not that I'm trying to be super conservative about it, but the last several adjustments that I've made to the soybean oil forecast have been some of the largest of my career. And so that's not, I don't want to do that. I don't want to add 5 cents when we can take 5 cents off the next week. So I'm trying to be a little cautious about our price forecast, but I do think that given expectations for South American production next year, it's going to be really hard to maintain soybean oil prices above 55 cents. Now that's, and I'm sorry, I mean futures. So whatever I've talked about, you can add sort of 10, 15, even maybe 20 cents to that to get to an RBD price. I follow your argument on the EPA RVO targets being okay for ethanol, but it seems to be short for renewable diesel. Yeah, this is where I sort of wish I had that chart. Basically what I did is I took the mandates, I took the mandate, and then I just started subtracting out things. And I did it in honestly a little bit of a strange way. I subtracted out ethanol, domestic ethanol production first because it's the largest, and then I did domestic biomass-based diesel production, so biodiesel and renewable diesel combined, and then I did biomass-based diesel imports, and then I did basically everything else, including ethanol imports. And that's where our current forecast came up. Now, our current forecast is certainly different from where production is now. Like I said, for renewable diesel, we have a relatively large increase in renewable diesel production built into our forecast. And I just want to look and see if these charts have updated, and I can actually show you our renewable diesel forecast while we're talking. Sorry. This kind of shows it. So you can see that by the time we get to, for April production was 174 million gallons. And by the time we get out to December, we've got it 268 million gallons. So I think that is probably maybe a little, there's one way that I could argue that I think that it's a little aggressive, and then there's another way that I could argue that I could actually raise it more. And the way that I could argue that I could raise it more is that, again, if you look at the capacity utilization rates implied by these production numbers, they still are relatively low. And so from that perspective, I think if you assume that all of the renewable diesel facilities that are supposed to open in 2023 open on time, don't have any problems getting pre-treatment set up, and then produce at run rates that make sense, then you could argue that renewable diesel production could be higher still. Even at that, it would take basically not quite 100 million gallons above our current 100 million gallons a month additional production above our current estimates to close the gap. That's a lot. I mean, if we were at 174 million gallons in April, that's more than half of that. So I think that it's going to be tough to close that gap. However, I do sort of get, and I don't disagree with the idea that that renewable diesel production could be stronger than we expect, or renewable diesel imports, foreign generation of renewable diesel could be stronger than we expect. That series has been a little volatile lately. And so there's a couple places, but even if you kind of look at all of those, it still ends up being there. If you get aggressive about your assumptions of what those are, you probably still are a little bit short. Now, in the end, it really is about what is the blend rate relative to consumption. And so targeting those volumes, again, they provide a framework, but ultimately you don't know whether that is, is 200 million gallons short good enough, or does it take 400, or is it 50? And so there's a little bit of, we're chasing a number that doesn't really mean anything. But I think with a gap that is that large, it's tough to argue that that can be sort of easily closed just by ramping up domestic production a little bit, or ramping up imports a little bit. I think our import assumption for 2023 for biomass-based diesel is like 820 million gallons. So that would almost double our imports to close that gap. All right. Can you clarify one more time how the ethanol mandate is announced as a percentage and then it gets converted to actual volumes? I thought it was effectively a volumetric mandate. So the mandates are announced volumetrically, but when individual obligated parties get their mandate, so you own a blending operation someplace, what you don't get is a volumetric mandate. What you get is you're going to blend 2% or 5% or whatever of biofuel, biomass-based diesel with the diesel that you use, or you're going to blend 10% of ethanol with the gasoline that you use. And so in that way, then really the volumetric mandates that are announced are, again, just sort of guideposts based on the assumptions that are made when the mandates are set. But the actual mandates will really be determined by the fuel consumption during the year, and will kind of change as that changes. And because of that, the ethanol mandate, while it's announced at 15 billion gallons every year, 15.25 billion gallons every year, if we're only using 135 billion gallons of gasoline, you can see where the shortfall is going to be. Either we're going to have to blend much more than 10%, or we're not going to get to 15 billion gallons, essentially. Hopefully that's clear. If not, write me an email and we can talk more about it. And that's not just for the question asker. Anybody, please, if you ever have questions after this, please let me know. With the 2023 mandate in the US not difficult to fulfill at all, can RIN values collapse at some point in order to contribute to the rationalization of biodiesel capacity? If you assume that the mandate's not difficult to fulfill, and you assume that we're going to overproduce RINs relative to the mandate, then you assume that the supply of RINs is what drives RIN prices. And that turns out not necessarily to be true for a couple of reasons. The primary one is the fact that you can carry RINs over from one year to the other, and you can carry over obligations from one year to the other. And so that has an impact on supply and demand. While you can do the same thing with corn, the tricky part with RINs is that they do expire. And so today's carryover is not necessarily the same as last year's carryover. And some portion of those RINs may expire. And so that disconnects RIN prices from the supply and demand fundamentals that drive prices in most markets. So beyond that, RINs are effectively an insurance policy on biofuel margins. And from that, you can kind of start to argue, okay, well, if energy prices fall, do RIN prices go up? And there's some correlation there, but not necessarily great correlation. If you look at it over a long period, and I actually owe this to one of my clients. She and I kind of went back and forth about this topic for a little while. And she finally kind of convinced me that if you look at the correlation between RIN prices and feedstock costs over a very long period of time, that is what really drives RIN prices. And so you can see the reaction that we got last week, where RIN prices had been down, 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 along with feedstock costs. You get a 5-cent bounce in soybean oil prices, and RIN prices bounce 10 cents. That's the same. There have not been any change in expectations about production or RIN balance sheets or anything in that. If anything, I would say that the expectations were that the RIN supply would increase because the EPA was going to raise its mandate. And so I don't necessarily think at this point that if you overproduce RINs, that you will collapse the RIN market. Now, having said that, we typically carry between 1.5 to 3 billion RINs over from one year to the next in the RIN bank, or at least as far as I can estimate it. If all of a sudden we had 10 billion RINs, I think that would have the potential to impact prices. So I don't mean that it could never have it, but I just mean at the margin, it probably doesn't. In a market where we carry over 3 billion RINs a year, an additional 500 million or a billion, I don't think makes a huge difference in RIN pricing. But I think this year we should have a very definitive answer one way or the other on all of that. Why are you still bearish on the LCFS outlook, given that CARB is confident on new targets in January 2024? I didn't think I was bearish. We have the LCFS credits going up, not quite as much as we did before, but we have them sort of steadily climbing into 2024 and then beyond 2024. I think that CARB will make some changes, and that will probably get the program back on the path that it was on earlier for a bit. But they're kind of in a whack-a-mole situation where, as they change the program, they tend to, in credit prices rise, they tend to attract more fuel, and that pressures credit prices. So it's kind of it's a very fine balance that they have to walk, I think, to get the results that they want from an environmental perspective, provide enough economic incentive to attract the fuel that they need to achieve those results, but not attract too much fuel so that they depress credit prices. So I don't think I'm bearish on LCFS credit prices. I think they're going to go up, and I think they're going to go back above 100. Big call from 80. But yeah, I think I just lowered the forecast this week a little bit, just because prices kind of had stalled here for a second, but it didn't change the shape of the curve. Latest EPA data was hinting to overproduction relative to the mandate. Why do you think we've been generating not enough RINs? All I'm doing is looking at the EMTS data that we have so far this year, and the volumetric mandates, and then our projections for the rest of the year, and just taking that volumetric total and subtracting out the forecast production that we have. There is a chance that I'm missing something, or that I haven't included something in the calculation. I thought that I had gotten everything in there, but there is a chance that I haven't, to the extent that that what I look at has a 180-degree different perspective from what the EPA sees. My suggestion would be that that would be relative to the percentage mandates and not the volumetric mandates. And so if we think about it in ethanol terms, it's certainly the easiest way to think about it. I assume that we're going to produce 14.4 billion gallons of ethanol this year. If you look at that relative to the 135 billion gallons of gasoline that we're going to use, that's way more than the 10% mandate that is the mandate. But it's way short of the 15 billion gallon volumetric mandate. And so that's where I think the difference is. And I freely suggest that the exercise that I did to go up to the total mandates is it's an exercise only, and it doesn't really give us a great perspective on the shortfall. But it does explain why I don't think that the EPA necessarily needs to raise the mandates, because if you look at it from that perspective, then we're not generating enough RINs to, or at least not enough production gallons to meet the mandates. Now, there is a whole nother part of that, which is the composition of the fuel and the number of RINs that are actually generated versus the number of RINs that are required. That just adds another level of complexity on something that, like I said, is already sort of a bit of an abstraction away from what is really going on in the marketplace. And so I didn't want to look that deeply into that. I just kind of wanted to make the point that from my perspective, based on our forecast, if you just look at the volumes, I don't know that the EPA necessarily needs to raise the mandate to provide some relief to producers, because they're going to way overproduce RINs this year. I don't think that would crack the RIN market, one, and two, I don't know that that's actually where we are from a volume standpoint. It certainly could be where we are from a percentage and a fuel consumption standpoint, for sure. And again, I'm always happy to, if you want to discuss this further, just send me an email. We will set up a time and we can talk about this in more depth. Can you get back on the possibilities for a small biodiesel company and what is expected for a starting biodiesel plant with a capacity of 30,000 gallons per day? Feedstock is UCO, but currently exploring degummed soybean oil. All right, I can send me an email, and we can talk about this in a lot of detail if you want. We can talk about it in a whole lot of detail, but send me an email and we'll talk about it outside of this call. All right, everyone. Thank you for all the fantastic questions this week. I will hopefully see everybody next week, and I hope everybody has a great week. All right. Thanks, everyone. Bye-bye.